Welcome to the Financial Statement Template series. This particular video will look at the income statement activity. This is a video series created and narrated by Professor Elizabeth Keating and produced by Yasmin Mezin. In the first video, Boston Bikes was created. It engaged in a set of things to get ready to open its doors on December 1st. What we're looking at right now is the state of the company on November 30th at the end of its first month while it was getting ready to open its doors. You can see the closing balances for the business on November 30th. And now Boston Bikes is opening its doors and is ready for business. What that means from an accounting standpoint is that the closing balances on November 30th are rolled over to be the opening balances at the beginning of December 1st. In this video, we're going to focus on what happens in the income statement when they start selling bikes. And so you'll see over to the right-hand side in green the income statement, and then it's a subcomponent of the balance sheet account called retained earnings. So Boston Bikes ready for its first transaction. It's going to sell $10,000 worth of bikes for $15,000 in cash. Think about how you would want to record that on the financial statement template. So here you can see all the way to the left, the cash has gone up by $15,000. And if you follow over all the way to the right in the revenue column, which has been added, you'll see $15,000. So from a revenue point of view, cash came in and revenues were recognized. This is called the realization principle. You can realize a revenue when a good or a service is delivered or rendered, but not before that. Now let's look at the red. You can see inventory declining by $10,000 as well as an expense for $10,000 being recorded all the way to the right. That $10,000 in expense is being matched to the $15,000 in revenues. The matching principle essentially says that expenses need to be recognized in the same period as the associated revenues. And now what you'll see appearing all the way to the right are two tan arrows. So those tan arrows are taking the amounts out of revenue and expenses and transferring them over to retained earnings. $15,000 in revenues minus the $10,000 expenses gives us a $5,000 increase in retained earnings. Now this transfer does not happen automatically. When we do accounting, we first store that $15,000 and $10,000 separately into revenue and expense accounts, and at the end of the month, as part of the closing process, the revenue and expense accounts will be closed and the net balance will be transferred into retained earnings. And now for our next transaction. The firm is going to sell $14,000 worth of inventory for $20,000, but rather than receiving cash, they will do it on credit, meaning the customer will pay them at some point in the future. So we can see over at the right that $20,000 in revenue, which is what was earned, realized by the company, and we can see $14,000 in expense, which is matching the cost against the $20,000. Now let's go see what's happening over on the asset side. On the asset side, we can see an account receivable being created for $20,000 and inventory declining by $14,000. So the $14,000 in inventory matches to the expenses. That's the expense recognition. And the $20,000 in the accounts receivable matches to the revenues, and that's the revenue recognition. Now you'll see I put a pink star at the top of the column for accounts receivable. That's because we have engaged in our first accrual journal entry. And so we're going to be creating an accounts receivable. And the reason this account is being created is because we have a timing difference. The revenue is being recognized, but the cash has not yet been received. And this is going to originate an account receivable. And at some point later in the example, you'll see the account receivable is reversed or partially reversed. Okay, our next activity is that the firm is selling some of its equipment. The equipment they're selling was on its books for $3,000, and it's going to receive $5,000 in cash for that equipment. So we can see we received $5,000 in cash going up. We're going to remove that fixed asset, that equipment from our books of $3,000, and the difference is $2,000 extra that the purchaser paid us. So that $2,000 we're going to state and show in the revenue section, but it's a different kind of revenue. It is a gain on the sale of equipment. And so one of the things you should note, when we sell equipment, we're going to put the net difference between the cash received and the equipment onto the income statement. In contrast to Activity 10 and Activity 11, where we put the gross amounts on the income statement, right? We put the full $15,000 paid by the customer in Activity 10 on the income statement, as well as the $10,000 in the cost of the inventories that was sold. Okay, our next transaction is that the firm is paying out $3,000 for advertising. Think about how you would want to record that in the financial statement template. Okay, so how we would record that is we would have a $3,000 payment of cash, so a decline in cash of $3,000, and this advertising expense is a current expense. In other words, it's providing a benefit for the current time period. And so that $3,000 will appear in expenses today, and at the end of the month, it'll get closed into the income statement. For our next activity, the firm is going to accrue $4,000 in salaries. You may ask yourself what accrue means. The meaning of the word accrue is that we're going to make a journal entry that does not involve cash. So why would we do that? Employees work every day, and often it's a convention you pay employees on the same day of the week, for example, Friday. But you're forced to, at the end of the month, to close your books. So let's say the month ends on Monday. On Monday, you're required to make a journal entry to recognize all the salaries earned through the end of Monday that belong in the old month. So this is that kind of journal entry. So let's see what's happening. Over on the expense side, we're going to reflect the salary expense of $4,000. But we're going to record at the same time a liability called an account payable for $4,000. And you'll see I have the icon both for bills and for a little time chart, meaning an accrued expense, both of them listed here. That is because sometimes salaries end up getting recorded as a salaries payable and being included in accounts payable. And sometimes when salaries are recorded, they're stuck into a separate account called accrued expenses. They're really very similar. They're both regular liability accounts arising out of running your business. The main difference is generally accounts payable. Things are charged to accounts payable when there is an invoice coming from a third party, and when the firm itself has to make its own calculation about the appropriate level of an expense at the end of a period. That's called an accrued expense. So sometimes salaries is thrown in one category or the other. But the question now arises, why is it we have a pink star? Pink star is because we now have made an accrual journal entry. You can see there is no cash in this journal entry. And so why is it we're having to book this? We're booking this because the expense for the salaries needs to be recognized in this month, even though the salaries weren't paid in this month. So we are creating an account payable and originating entry, and we'll be paying the employees at some point in the future. So another customer walks in the door ordering merchandise. He's not taking the merchandise today. He's just placing an order, and he's going to give the store $6,000 as a down payment. So notice over in the revenue and expense area, there's nothing recorded because we actually didn't do a sale. We didn't deliver the bikes to the customer, so we have not fulfilled the realization concept. We cannot book a revenue. We have, however, received cash. So you can see over on the asset side, over on the left, the cash has gone up by $6,000. So the question is, what is the offset? That customer on good faith has given us $6,000 with a promise that we'll deliver the goods. So right now we owe that customer back his money if we don't deliver the bikes. So we're going to create a liability called an unearned revenue or a deferred revenue for $6,000 at this point in time. So this is a third type of an accrual journal entry. And the reason we're creating it is that cash was received now in advance of revenue being recognized. We're going to declare and pay $2,000 to our investors in the form of cash dividends. So you can see cash of $2,000 declining in activity 16. And you can also see, if you go over to retained earnings, a special orange cell of another negative $2,000 and a happy investor. So most of the changes in retained earnings are due to revenues and expenses that appear on the income statement that then later trickle into retained earnings. There is a notable exception, however, which is when we pay dividends. When we pay dividends, we take it directly out of retained earnings. It does not first appear on the income statement, and hence I've specially color-coded it there as orange. Our next activity is that we're going to pay the employees the $4,000 we owe them. So we have cash going out the door, and the account payable that we created in activity 14 is being reversed by $4,000. So now if we look at the account payable column, we'll see it went up by $4,000 and now has dropped by $4,000. Note also, we're paying the employees right now for prior work. We are not recording a new expense. We've already reflected the expense when we recorded activity 14. Some of our customers have just mailed us a check for $14,000, so we've collected $14,000 from the customers on prior sales. What this means is cash is going up by $14,000 and accounts receivable is dropping by $14,000. So again, let's look over at the income statement and you'll see there's no revenue and expenses being recorded. Why is that? It's because back in activity 11, we booked the revenue associated with that transaction. So we've already recognized the revenue associated with this transaction. All we're doing right now is saying that that unpaid balance that they owed us, a portion of it has been paid off. And now we're going to deliver 3,000 of the goods previously ordered from us, and the cost of the goods that we're delivering is $2,000. So what we can see occurring here, let's start with the expense side, which is we have inventory of $2,000 leaving, and we've recognized an expense of $2,000. That's the expense portion. We're going to recognize revenues of $3,000 because that's what we delivered in goods. But what's a little different about this transaction is what is the offset to that $3,000. We took in $6,000 and promised to deliver some bikes. We delivered half of them. So we're going to reduce the unearned revenue by $3,000, which is the amount of the goods we delivered. Okay, now we're going to look at another activity. Last month, in November, we prepaid for an insurance contract. Now this month in December, we've benefited from that insurance contract. So we will have used up, consumed $1,000 worth of the prepaid insurance that we had. So we had previously had, if you look at the opening balances under prepaid expenses, we had prepaid $10,000 on an insurance contract. Now what we're going to do is say 1,000 of that prepayment we have benefited from, used up. So we're going to drop prepaid expenses by 1,000, and we're going to recognize an expense of 1,000. Okay, so now we're done recording the activity for the month, and it's time to compute the closing balances. To do that, we're going to start at the top in the opening balance and then add all the black positive numbers and subtract all the red negative numbers to end up with the amount that's remaining. So I want to take a minute and look in a little more detail at what's happening all the way over to the right where the income statement is presented. So we can see in the white columns of revenue and expenses, revenues and expenses being depicted. And now what's happening as part of the closing process, we will first draw up the income statement, which we'll do in just 1 second. And as a result of that process, we are going to close the revenue and expense accounts and transfer those balances over into an account called Income Summary. And from Income Summary, they will get posted into retained earnings. So I'm going to walk you through how that works. To start the income statement, we're going to write the name of the firm, Boston Bikes, the name of the statement. I've written here statement of operations. It could also be earnings statement or income statement or profit and loss statement. And then we need to provide the time period. So it's for the month ended December 31st, 20XX. And what I've gone ahead to do is to record the sales revenue. So that will be the sale of products that have occurred. And so if we look at the various transactions that have been recorded, we have the initial 15,000 of bikes we sold, then a second transaction of 20,000, and then there's that 3,000 that we delivered on that transaction where the customer came in and put down a $6,000 order. So when we add those items together, we come up with 38,000 in revenue. Next, we're going to look at, using the matching principle, the direct cost of those sales revenues. So what was the value of the inventory we sold? Well, in the first transaction, there was 10,000 in inventory we sold, then 14,000. And then in the very third transaction, it was 2,000 in inventory that we sold. So we add those together. The cost of the inventory we sold was $26,000. Although we're not required to do it, we're going to show a helpful subtotal, which is the difference between the sales revenue and the cost of sales. So that would be the gross profit of $12,000. Now we're going to look at the various operating expenses that we recorded. So essentially we're going to look at the remaining numbers in the expense column and see if they're appropriate to put in this section. So we'll see there's 4,000 in sales revenue, 3,000 in advertising, and finally 1,000 in insurance that was recognized. So all of them will be placed on the income statement. So now we can add up the various expenses and find we have total expenses of $8,000. So we can compare that to the gross profit of $12,000. We have operating income of $4,000. But we're not done yet with the income statement. We skipped over one transaction, and that's the $2,000 you can see sitting under revenue. That, if you remember, is the gain on the sale of the equipment. That's a different kind of income than the sales revenue and cost of sales from inventory. This is the sale of property, plant, and equipment. And it's not part of general operations. So we're going to put the gain on sale of equipment further down below operating income. Now we're ready to compute the grand total, which is net income of $6,000, which is the operating income of $4,000, plus the gain on sale of equipment of $2,000. So this is the first part of the closing process, which is to compute net income. Now that we've computed net income, it's time to move on and prepare the statement of retained earnings. I've already written it out here, and you can see the red arrow highlighting the top of the retained earnings calculation, which is we started the period with no retained earnings. We're then going to add in the net income of $6,000. And now we'll take the $2,000 dividend distribution and deduct it from retained earnings. And now we've completed our calculation of retained earnings. So retained earnings at the end of December is $4,000, which is composed of the $6,000 in net income less the $2,000 in dividends. And we'll use that to update the retained earnings at the bottom of the financial statement template. So That concludes our look at the financial statement template and how to record income statement activity in it. Thank you.